Ever wondered what happens to your investments when the stock market crashes? Let's dive into the nitty-gritty of market crashes and how they impact our investments. A market crash is a sudden, drastic drop in stock prices across a significant cross-section of the market. This drastic drop can be triggered by panic selling, economic crisis, or even a global pandemic, as we saw in early 2020. When the market crashes, it's not just individual stocks that take a hit. The value of your entire portfolio can plummet, causing a significant loss, at least on paper. Now, this may seem terrifying, but it's crucial to understand that the value of your investment is somewhat fluid. It fluctuates based on market conditions and the perceived value of the stocks you hold. When the market crashes, the perceived value of your investments drops, and so does your portfolio value. But here's the key thing to remember. This is only a paper loss, not a real loss, unless you sell your investments. Fear and uncertainty are the twin demons that often accompany market crashes. The media headlines scream doom, your portfolio value is sinking, and there's a general sense of panic. It's easy to get caught up in this whirlwind of negativity and start doubting your investment decisions. But remember, fear is a reaction. Courage is a decision. You might be tempted to sell your investments to stop further loss. But selling during a crash is like locking the stable door after the horse has bolted. It's a reactive strategy that might cause more harm than good. Instead, consider this as a temporary situation, a storm that will eventually pass. Remember, a market crash doesn't mean your investments have lost all value. It's a temporary situation. The market has a history of bouncing back, even from the worst crashes. So take a deep breath, hold on to your investments, and wait for the storm to pass. The sun always shines after a storm, and the market always rises after a crash. Think you need to scramble during a market crash? Think again. When the market takes a nosedive, it's natural to feel a sense of panic. After all, no one likes to see their hard-earned investments plummet in value. But before you hit the sell button, take a deep breath and consider the do-nothing approach. Yes, you heard it right. Doing nothing. It sounds counterintuitive, doesn't it? But the truth is, panic selling during a market crash can often lead to regret. You see, the market is inherently volatile, and downturns are an inevitable part of the cycle. But history has shown us that over time, the market tends to recover. Take, for instance, the market crash of 2020. In the spring of that year, the S&P 500 fell over 30% in a very short period, causing some investors to jump ship in panic. But by the summer, the early COVID market losses had been erased by a rapid rally. And those who had sold off in spring, they missed out on a 65% gain from the bottom of the crash by the end of the year. Now, this is not to say that the do-nothing approach is always the best strategy. It largely depends on your individual circumstances, your financial goals, and your risk tolerance. But if you've built a diversified portfolio with a long-term perspective, there's a good chance that holding steady through the storm could be in your best interest. Remember, the value of your investments doesn't really matter until the day you need to cash out. So, unless you have a compelling reason to sell, it might be wise to sit tight and weather the storm. After all, the most successful investors are often those who can keep their cool when the market heats up. In the face of a crash, sometimes the best action is inaction. A market crash may seem like a disaster, but for some, it's a shopping spree. When the market takes a nosedive, it's not all doom and gloom. On the contrary, it can be a golden opportunity for strategic buying. Think of it as a clearance sale at your favorite store. The prices are reduced, but the value of the items remains the same. In the world of investing, a market crash often results in discounted prices for stocks and funds. This is largely due to reactionary selling and the ripple effect of aggressive speculators liquidating their holdings. While this can contribute to the overall market decline, it also presents an opportunity for savvy investors. You've probably had your eyes on certain stocks or funds, but their prices were just a little too steep for your liking. Well, a market crash might just be the time to make your move. These assets could now be available at a fraction of their previous cost. It's like getting a designer suit at a thrift store price. Now, if you're a novice investor, you might be wondering where to begin. Well, here's some advice. Index funds are a great starting point. According to Paul Miller, a New York-based certified public accountant, buy them on a regular pattern, consistently. then go to sleep at night. Simple, right? Index funds offer a broad market exposure and are typically associated with lower risk compared to individual stocks. But remember, the key to successful investing, especially during a market crash, is discipline. Don't let the fear of further dips deter you from your investment plan. Stick to your strategy. Continue buying shares on your regular investing schedule, and remember that market crashes are temporary. So the next time the market crashes, don't panic. Instead, put on your shopping hat and get ready to bag some bargains. A market crash doesn't always signal doom. For the savvy investor, it can be a golden opportunity. Worried about investing all your money at the wrong time? Dollar cost averaging can help. This strategy is a lifesaver, especially during a market crash. It's a simple concept that involves investing a fixed dollar amount regularly, regardless of the market's ups and downs. Think of it like a subscription to your favorite magazine, but in this case, you're subscribing to a piece of the market. During a market crash, prices go haywire, and it's easy to get caught in the fear of investing at the wrong time. But here's where dollar cost averaging shines. By investing the same amount of money consistently, you buy more shares when prices are low and fewer when prices are high. This way, you spread out your investment over time, and you're not trying to time the market. So why is this strategy beneficial? First, it reduces the risk of making a large investment at the wrong time. It's like dipping your toes in the water before taking the plunge. You're not committing all your money at once, and that can be a relief, particularly during volatile times. Second, dollar cost averaging brings discipline to your investment routine. It's like having a workout schedule. You don't decide whether to exercise based on how you feel that day. You do it because it's part of your routine. Similarly, with dollar cost averaging, you're investing regularly, regardless of the market's mood swings. Lastly, this approach provides emotional comfort. It's natural to feel anxious about investing during a market crash, but knowing you're not putting all your eggs in one basket at a potentially wrong time can help alleviate those fears. If you're investing through a workplace retirement plan, chances are you're already using dollar cost averaging. If you're investing on your own, most brokerages offer features to automate your contributions, making the process even easier. With dollar cost averaging, you can take the guesswork out of investing, even during a crash. It's a strategy that helps you stay committed to your investment plan, reduces risk, and offers emotional comfort. So, next time the market crashes, remember, consistency is key. Want to make your investments work even harder during a crash? Consider hunting for dividends. A market crash can be as much an opportunity as a threat, especially if you're willing to venture off the beaten path. One such path leads to dividend-paying stocks. These are shares in companies that distribute a portion of their profits back to shareholders. It's a bit like receiving regular interest on a savings account, but potentially with higher yields. Investing in dividend-paying stocks during a market crash can seem counterintuitive. After all, aren't companies likely to cut back on dividends during tough times? Some may, but many companies pride themselves on maintaining or even increasing their dividends, come what may. This steadfastness can provide a steady stream of income, even when the markets are taking a nosedive. Here's why hunting for dividends during a crash can be beneficial. First, it allows you to buy more shares at a lower price. Since dividends are often paid out on a per-share basis, this means you can potentially earn more from each dividend payout. Second, it provides a source of income that isn't tied to a stock's price. So even if the market is in turmoil, you can still see a return on your investment. But it's not all smooth sailing. Dividend hunting requires research and a keen eye for detail. You'll need to assess a company's dividend history, its financial health, and its ability to generate profits in the future. Remember, dividends are not guaranteed, and a company can cut or eliminate them at any time. It's also worth noting that investing solely for dividends can skew your portfolio towards certain sectors. Some sectors like utilities and consumer staples are known for their high dividend yields, but they may not offer the same growth potential as other sectors. So, while dividend hunting can be a fruitful strategy during a market crash, it's important to consider it as part of a broader, diversified investment approach. A market crash doesn't mean your investments can't still generate income. With dividends, you can keep your portfolio working for you.